Let's turn to the economy right now. There's been a stunning sell-off on Wall Street following continued record high inflation. The Labor Department and Statistics Department put out inflation at 8.3%. The cost of food, a lot of people are affecting this. Among the drivers are eggs. They're up 38%. Muffins and rolls up nearly 14%. Milk up more than 15%. All eyes are on the Fed next week for what is expected to be a rate hike. We want to welcome in a familiar friend to this program. Mark Avallone is the president of Potomac Wealth Advisors. Mark, it's good to have you back on the program. This past week, the White House held what a lot of people termed as a victory lap on inflation, where they were celebrating what they call the IRA, the Inflation Reduction Act. It came on the same morning as this report, Mark, that showed inflation is still not under control. Talk to me about the optics of that. On the one hand, you're having the White House holding this victory lap on inflation, and yet that same morning, numbers come out that say just the opposite has happened. Inflation is not being reduced.
Well, it was a bit tone deaf. They're standing behind it, saying that in the long run, they believe what's inside the bill will reduce inflation. That really is a long shot. I'm not sure spending money is a recipe for lower inflation. In fact, that's one of the reasons we have such high inflation, because Congress was spending money and the Federal Reserve was making money cheap and easy. So more money leads to more inflation, not less.
You know, we spent so much time this year talking about gas prices. And yes, gas prices have fallen a lot. But year to year, it's still too high for a lot of people's pocketbooks. And what we just talked about of what's going on at the grocery stores right now, people are not getting any relief about this. So translate that for us. What's going on in real people's lives versus what's going on in Wall Street. Why did Wall Street have the week it had? Is Wall Street worried about Wall Street, or are they concerned about what's going on in small areas like the grocery bills, like people's household incomes?
Right now, there are so many challenges for stock investors, for Wall Street, the markets. There's still that war in Ukraine. There's China shutdowns. And you're mentioning energy. Energy is a big problem in Europe. Russia's shutting down their pipelines, and energy prices at home are still high. Food prices at home are going up. Inflation is public enemy number one to people on fixed incomes and retirees, and that's why the Fed wants to raise interest rates to lower inflation, to slow this economy down.
Okay, let's delve into that a little bit. When people hear the Fed's going to rise or lower things, maybe they'll glaze over a little bit in their eyes if they're not really that plugged into it. Why does raising these rates help lower inflation?
Well, let's say you have a home mortgage and you're paying 3% interest, and then a year later it's 6% interest, right? The cost for you to live in that house has doubled, and that's what's happened in interest rates. The higher interest rates are, the higher it is for people to live every day. Buying cars goes up, buying a house goes up. Business investment decisions are affected. So inflation leading to higher interest rates slows the economy. That's what hit Wall Street this week. Wall Street's worried that the Fed's going to succeed in slowing the economy down. And slower economy is slower earnings, bad for stocks.
One of the economists I spoke to this past week says they're very worried about what's going on with deficits right now. All of this spending, not only through the Inflation Reduction Act, as it's called, but we've had the stimulus spending through the COVID situation, these refund checks, all this money that's been pumped into the economy, that it's artificially boosted what we have been dealing with in the economy. At some point, when we get to a normal amount of spending, doesn't that create an imbalance in this economy that we're not really living in reality right now, but what real spending should be?
Well, deficits, you're right. Deficits are a ticking time bomb, and what's worse is the debt has to be paid or at least serviced. And with interest rates having virtually doubled in the past 2 years, the cost of that debt has gone up. So the higher the amount of government debt and the higher interest rates, the bigger the future problem. But politicians don't look long term. They only look short term.
Wall Street has been reactionary. Should we expect more of that this week when the Fed makes this move?
Absolutely expect choppy, rough markets. The bigger the party, the bigger the hangover. And we had a heck of a party on Wall Street since 2008. So I would tell investors, do not get emotional, and it's going to be a rough ride.
He is Mark Avallone from Potomac Wealth Advisors. We thank you so much, Mark. Great to see you.